This is part 2 of 2 regarding Wall Street smoking gun. This time I'm going to cover a lot more of the second leg of this service, which is the high premium report. All right. Now let's cover the smoking gun first. I covered this last week, but I'm going to go over it a little more quickly this time. And if you miss something or something's confusing, you can always go and watch last week's video. But basically it's this. With our products, we've basically taken the technical analysis as far as we can go, like power scan, signature, track trading, etc. All these features and services are second to none. They do the best job that I know of to locate really good chart setups. However, we need a way to detect info that's not in the charts, insider info, if you will, big money plans and intentions. Okay, hence Wall Street smoking gun. Now, it's a way to detect abnormally large bets on a stock's future direction. And to understand this, you have to understand option basics, which I'll go over very quickly since I've done it like 50 times. An option, or a call option, is the right to buy shares from someone else for a certain period of time. In this example I'll give, let's say you have 10 days to buy shares at some fixed price. Now, to get that right, you have to pay a premium. Here's an example. There's a shareholder that holds 100 shares of Microsoft, and the current price at that time is $27.50. Now, that shareholder can issue an options contract to someone else like me or you that we pay for the right to buy 100 of those shares at $27.50, and this contract expires in 15 days. To get that right, we pay what they call a premium to the shareholder. So he makes 50 cents a share off of us for the right to buy his shares at $27.50. Now, it doesn't matter what the stock is. Within 15 days, if the stock is $50, you see, he still has to sell it at $27.50. What this does, however, is it gives you leverage of big stock for pennies to the dollar. So you notice we're only paying for Microsoft 50 cents a share, as opposed to $27.50 a share. Now, we don't own the stock, but if Microsoft goes up in value during that contract, those options, those 50-cent options, go way up along with it. And it's exponentially huge. And so you can leverage big stock with pennies to the dollar. The major point is this. The person who buys a call option is betting that the stock makes a move in the near future. That's obvious, right? But hence, options are, in a sense, stock futures. Now, put options are also available. They're the opposite of a call option. A put option is the opposite. See, a call option, as we discovered, is the right to buy a stock. Okay? A put option is the right to sell a stock. Or another way to say it is the right to sell short. Okay, so if you own a call option and the stock rises, the option value goes up with it, and it goes up exponentially. A put option does the opposite. If the stock falls, the option rises. Hence, put options are great leverage for like when you're betting on the downside. It's also an excellent way to be short without going short, if that makes sense. Now, here's the bottom line of how this whole Wall Street smoking gun thing came about. The market is inundated with opinions, right? You got opinions everywhere, books, newsletters, TV shows, financial advisors. You got Mad Money Kramer, all these people. And even our own forums have opinions all over the place. But whose opinion matters the most? And I have the answer to that. The answer is the large player, the one who has cash on the line. That's whose opinion matters the most. Because they are so sure of the direction that they're betting on that they're willing to put their money where their mouth is. Now, I first paid attention to this a while back. We had, in Gar's Gold Room, we had this stock, RF, Regions Financial, I think is the name. It was trading around 10 bucks. After I decided that it was a good play, I suddenly noticed there was 6,000 call option contracts for a $10 strike. Now, the normal options for that stock is about 100 per day. Now, that is a giant, giant, giant glut of options. The next 2 days, RF went on to soar. We all made a nice windfall on the options. Now, that was just dumb luck, okay, because I wasn't really looking for any option increase. I just happened to notice that. And I'm thinking, somebody had to make a giant, massive bet. I mean, 6,000 call options probably cost about, I don't know, $100,000, something like that. I mean, it was just an unbelievable thing. So I decided I had to find a way to detect these in advance. Hence, Wall Street smoking gun. Now, what this is, it's a real-time report on above normal options volume. Now, one of the things I know some people are going to say right out of the gate is, oh, Gar, I can already find that out. There's services out there that tell you. No, they don't. Number one, I researched this. Almost every one of them report at end of day. And oftentimes that's too late because, the deed is done. Second of all, they can be kind of expensive. Third of all, you have to know how to interpret the data. And that's where I come in. That's where our other tools come in. That's where your expertise in stocks come in because you use our other products. And I'll get into how you refine your picks in a few minutes. But basically, this service scans literally every option in existence. It scans, well, not every option. It scans all options that are reasonably liquid. Like it won't scan an option that gets one contract every 30 days or something, right? Like almost every day is a zero. It won't do those. But it'll do, I think, all the way down to one contract a day, volume-wise. That's about, I think it's about almost 3,000 stocks, and it's literally 300,000 option contracts it has to scan. All the strike prices and all the expirations. The question is, does this really work? I mean, come on, The answer is yes, of course it does. I wouldn't be having this webinar. I wouldn't be pitching this stuff. I just want to, somebody made a comment. It was Bush that said, not to interrupt, but selling puts is a great strategy of going long a stock and reducing its cost, blah, blah, blah. Yeah, I agree. I'm going to cover that, by the way, in this webinar, selling puts. Okay, back to, I usually don't respond to questions midstream, but I thought that was intriguing because we are going to cover the whole selling put thing. Yeah, does it really work? Yeah, it does, and let me give you some examples. These are actual picks that I discovered with this smoking gun report. All right, 31 December, silver, SLV. Okay, I'm showing you the chart prior to this stock making a move. This was on the 31st of December, New Year's Eve. There was a sudden spike in SLV calls, 19,000% increase. That's a lot, okay? Now, one could say, yeah, but somebody's just hedging a position. Yeah, maybe. But I'm going to show you in a few minutes how you differentiate between a fluke and a real live bet that somebody's making or some group. Okay, now the reason I found this one intriguing is because look at silver. This is a 30-day chart. Look at that. Silver hasn't done anything for like days and days. As I recall, silver was pretty poor all throughout 2015 generally. So I decided it was very interesting, and check it out. Look what happened. I'll show you the next chart. There's where we got the 19,000% increase in options, right? Take a look at the rest of that chart. Look how that thing flies. That thing soared about, oh my goodness, it looks like 10%. Imagine holding options on SLV. My goodness, windfall city. Okay, so that was the first experiment. Same day, December 31st, TZA had a 7.1,000% increase in calls. Now, TZA is a bear ETF. The reason this one jumped out at me is because it was a bear ETF, and the market was positive that day. So I'm thinking somebody somewhere thinks so certain that the market will tank that they're loading up on TZA, which is small cap bear ETF. I think it's a 3x or 2 times 3 leverage. Check out the chart right after that. Pretty amazing, isn't it? That looks like another 10%er to me. Okay. Then we got January 6th, after the holidays. By the way, you think I'm cherry picking? I am, and I'm going to tell you there's a reason for it, because every day does not necessarily have a good pick. And I'm going to show you how you differentiate. But this was a real interesting one. On January 6th, this little cheapy stock, FRO, was trading around $3. It had gapped way up. You see that gap up? And it was hovering, and it was holding its gap. 37,000% increase in call volume. That was very intriguing, and check out the rest of the chart. It's just, was just one after another that you can find like this. I don't sound that excited, but that's because I've gone over this in these webinars like 6 times, but this has just blew my mind every time I'd find these. All right, here's another one, FLML. This was just a few days ago. I found this one intriguing because look how that stock is tanking badly. This is a 30-minute chart. Right there where I'm showing the arrow is intraday, midday. It suddenly had a spike in call options, 18.7,000% increase. It was right there on the smoking gun report. I said, wow, that's a weird one. You'd think there'd be puts, right? But they're buying calls. What's interesting is they're buying them there, not an hour before then, right? Not the previous day, but right there. I'm thinking that traders must know something. It's like at support or whatever. Check it out. Sure enough, that thing ramps up and ramps up for 2 days. Pretty cool. And that doesn't look like a whole lot because of the scale of this chart, but where that arrow's pointing, that's $10.50 stock, where it's closing right here, which was, by the way, I think was Friday. Where it's closing right there is almost $14. That's a 4%. Is that 4%? Or is that 40%? It's double digits. I can't do the math, but that's just an astronomical gain for a 2-day hold. It's just totally cool. Now, like I said, you're going to think I'm cherry. By the way, I only showed you some that are really interesting. There's a whole bunch of other examples that also were winners. A lot of you users who are using it already know about some for yourself. But the false positives are really the name of the game. See, the truth is, just because there's a big spike in options does not necessarily mean it's a good trade. And I'm going to show you something that is so idiotically simple that you might even laugh. You might say, oh, come on, it can't be that simple. I'm going to show you how you weed out the false positives. When you get a spike in options volume, it means one thing, and only one thing. It means someone or some group thinks the stock will make a move before expiration. Now, there are some cases where that's not true. There's some cases where they're going to be buying options for other weird reasons, like to hedge a position, or like as Tube Guy pointed out today on Gar's Gold, a lot of people like to sell puts and sell calls both out of the money, right? And they're hoping that the stock goes sideways and that they expire worthless. That's a strategy a lot of people use. Okay, it could be one of those things, but generally speaking, the reason somebody would make a large bet is because they think it's going to make a move. But what if they're wrong? They could be wrong. How do you mitigate the risk? You're not going to believe how simple this is. But I have not found an exception to this rule. Not one. It's called confirmation. I mean, duh. Remember the SLV? Okay. All you knew is that somebody made a bet on SLV, 19,000% increase. Well, guess what? It needed confirmation. What kind of confirmation did we get? Right there, it uptrends. There's your confirmation. So if I came in, you say, Gary, what do you mean by confirmation? What I mean is, whatever you use for confirmation, whatever you are comfortable with, charts, trend, moving averages, whatever. Like if you're really a stickler on technical analysis, watch a simple moving average. If the stock starts rising above that, that's probably a confirmation. So whatever you're comfortable with. But this stock is confirmed because there's where you're getting your action. And the very next day it spikes way up, it falls back again, but then it spikes again. Okay, that to me is good confirmation because they're really trying to jam this thing higher. So realistically, in fairness, I probably wouldn't have entered until here. Okay, but look, you still ride that thing up. Okay, there's a confirmation for you. And you'll find that every one of these I showed you have confirmation. Now, here's one where you don't have confirmation. Now, I didn't mention this one because it was a loser. Well, you could have known it was a loser. XLY got 30,000% increase in calls the same day that XLV got. Okay. How do you know to go with XLV and not XLY? The answer is confirmation. Notice that XLV, and right there where I'm pointing the arrows where it got the 30,000% increase. I don't see any confirmation there to you. All I see is the stock crashing. That would have been a total non-trade. Now, you can say, yeah, but why did it get a spike in options? My answer is, I don't know. Maybe some idiot. I've noticed that I haven't seen XLI get much action ever since. I even checked for right here, to see if it was getting action there, because notice how it bounced. No, it wasn't even getting action there. So this was not exactly the smartest money in the market. But my point is all you got to do is you got to be a little bit patient, and you got to exercise judgment. If you like something that jumps out on the smoking gun list, wait for confirmation, for heaven's sake. And I'm telling you, I'm not exaggerating this. I have not seen a single stock fail yet on the confirmation list. In other words, I haven't seen a single stock on the smoking gun report fail if it had a confirmed increase or a decrease if you're going short. So always confirm. That's the way you weed out the bad guys. But if you do that, the data within smoking gun is super, super valuable. Confirmation can be as simple as an uptrend or as complex as technical indicators. It's up to you. It's whatever you're comfortable with. The market itself is often confirmation. Just don't forget that too. If the market's tanking, it is less likely a good choice will rally. Confirmation doesn't have to happen all at once. It could happen the next day or the day after. I've seen some take 3 days to confirm. Expiration of the option could matter. For example, if the expiration of the option that's getting volume is 3 months out, confirmation might take a while, okay? Because whoever's making that bet is assuming the stock will rally within 3 months. It could do nothing for a few days at least, okay? So always pay attention to the expiration because it might matter. And I'll show it to you for those who haven't seen it. Right now, smoking guns available inside Traders Unite. That's not going to always be the only place. Very, very soon, probably by the weekend, we're going to have it available on a web page as well for people that have no interest in Traders Unite. Remember, Traders Unite is not the center of the universe, even though I'd like it to be, but it's here for everybody's convenience. So, if you've never bought Smoking Gun, if you don't subscribe to it, if you click this, you won't get the window. You'll get a, you need to own this, bud, buy now, question mark kind of thing. But if you do own it, you'll get the window as thus. This updates itself about every 15 minutes. Now, for those who are going to say, but it doesn't update, there is a minor glitch that I'm going to fix tonight, which is usually when it gets an update, I usually have to close the program and open it again for it to recognize the new update. But I'm gonna fix that. But it updates about every 15 minutes starting at 9:45 a.m. We might increase that a little bit. We might do it every 5 minutes. I'm not sure, but that's what it looks like. And by default, it sorts by increase in volume. And you just take a look at them. You see, this is the end of day report. Intraday, it would have looked a little different. Somebody pointed out that this Denny's, D-E-N-N, has a spike in calls, right? And I found that very weird, and so I was very interested in it. Then somebody pointed out that it also has a spike in puts. See, there's D-E-N-N. And they're both way out of the money, and it's like, oh, duh, this is somebody either betting a big straddle, or they're doing what Tube Guy was saying, which is they're selling a call and a put out of the money, hoping that they expire. So you got to pay attention to things like that. So remember, it takes human intervention. Anyhow, this is your list. I really don't have to say too much about it, but you can also go back and look at previous days. Remember, we were talking about that FLML. See, there it is right there. I was on the 14th. You can also double click and take a look at the chart. And et cetera, et cetera. Now, one thing I did not mention is that it tells you when the last report updated right up here on the right, but it also gives you the put-call ratio. This is a very important number. That number is the total number of calls being traded divided by the number of puts. That gives you, that's kind of sort of how the VIX is computed, by the way. The lower that number, the more bearish the market is, or the more fearful they are. The higher the number, the more bullish they are, more optimistic they are. Today the number is awfully low. It's below 1. To put that in perspective, the call put ratio a week ago was 1.8, and now it's 0.9. It's basically gone down by half. That means the market is getting really afraid and bearish. Now, if you want to see news on a stock, you just click on the one you want and you just click news, and it'll give you Yahoo News, which is pretty accurate. You can maybe figure out why it might have an increase in volume. Now, email is how you can get the system to email you these reports at periodic moments. I want to emphasize this doesn't work quite yet. You can enter data and it'll save it, but the system does not send emails yet. I'm working on that diligently to get that to happen. It tells you when your account expires down here, and if you want to renew, you click renew. All right. That brings us now to the high premium report. I didn't cover this at all in the last webinar, but this is actually, in some cases, depending on the kind of trader you are, this is actually more valuable than the smoking gun report. Now, to illustrate why this is important, remember our example of Microsoft. Let's say you're the option trader and you're buying the options contract for Microsoft at 50 cents a share. Okay, that's the example we use when we're discussing options trading. However, there's another side to this trade, and that's you. You could be the guy that owns Microsoft selling those options to somebody else. All right. In that case, you would get the 50 cents a share, and that's your money no matter what happens. Selling options is the market's safest play as you become the house side of the casino. Okay, that's the upside. You know, the house side of the casino, I'm being kind of sarcastic, but there's truth to that. Because a lot of these guys that are playing options are just gambling. And the options often expire worthless. So if you can exploit that, you can make a ton of money being on the house side, as it were, owning the stock, selling shares against it. The worst case is you lose your stock, but you've made money on the stock anyway, so who cares? It's a great strategy, especially if you have a large account or an IRA or something. The downside is that your gains are limited if you're selling covered calls, which is what this is called. We'll get into that in a sec. It's very safe, but it's very limited. Okay, the reason it's limited is using that Microsoft example. If you're selling options for $27.50 and Microsoft is trading around there, okay, you're getting 50 cents a share. That's a good deal, right? The problem is, what if Microsoft goes to 35? You're forced to sell those shares at $27.50. Now, you haven't lost anything. In fact, you've made 50 cents a share, but you've missed out on the $6 upside to the stock. And that's the downside. But low risk, lower reward. Because selling covered calls is very, very, in fact, it is so quote-unquote safe that I believe they let you do this in IRA accounts. Now, there's three main ways traders get involved in selling options. Now, I know somebody's going to say, oh, God, there's this way, there's that way, there's this spread and that spread. I don't care. I mean, yes, I know. There's all kinds of different fancy methods, but I'm only going to cover three of them that are the most common tonight. And believe me, we are leading up to the whole point of high premium report. There's three main ways traders get involved in selling options. One way is writing covered calls, which I just explained. That's owning shares and you sell options against those. Selling naked puts is another way. That's when you sell a put and you don't own any position. I'll cover that in a sec. And then there's trading credit spreads. There's a couple of guys on our forum that trade these credit spreads all the time, and they have their upside and downside, which I'll cover here in a sec. Writing covered calls is you sell call options against stock that you own. You keep the sale proceeds regardless of what happens to the stock. By definition, you agree to sell the stock at the strike price if the option holder chooses to exercise. For example, if you're selling Microsoft $30 calls, you are called out if Microsoft is $30 or higher by expiration. Advantage of writing covered calls: they are low risk, very little downside potential. Most IRA accounts allow writing calls for this reason, even though they won't allow options trading per se. It involves no margin, which is also why they are low risk. The disadvantage of writing covered calls: you must own the stock, hence account is fairly large to make large profits. I mean, if you own 100 shares of something, and that's all, yeah, you could sell one contract, but what are you going to get, $10? See, that's a disadvantage. In fact, you have to own the stock to sell covered calls. Means that this is something for a large account. IRA would be perfect for it, actually. And the second disadvantage, your upside on the stock is capped. Now, selling naked puts. This is a very, very popular strategy. There's a couple of guys on the forum that are constantly talking about doing this. They don't use the term naked. But the reason they're called naked puts is because you don't own anything and you don't own anything short. You just sell the puts. And what the arrangement you have with the broker is as follows. If you sell puts, you're obligating yourself to buy the stock at that price. So in other words, see, if you're selling a put option contract, you're selling somebody the right to sell that stock to you for a fixed price. Now, in order to do that, in order to make that go through with your broker, you have to have enough margin to cover that in worst case scenario. So if you're selling 100 shares, if you have 100 shares of something that's $30, right? That's $3,000. If you've agreed to buy that stock at $30 and you're selling puts against it, that means you have to come up with that $3,000 if the put gets exercised. Hence, you have a liability of $3,000. Now, if the option expires worthless, you're off the hook and you keep the money. But the reason naked puts are a great play is because it's a way for traders to make money without holding any position, number one. And it's also remember, it's also a way of going long, because if you're selling a put, that means that you don't think you're going to have to pay up, which means you think the stock's going to rise. Now, we could go on and on and on about selling put strategies with charts, analysis like, is the stock oversold, which means it's likely to bounce. I mean, we could have a whole webinar on just how do you figure out what a good naked put sell is. But that's not part of this webinar tonight, so I'm not going to go too much into that. Your liability is the put strike price times number of shares. For example, if you sell 100 Microsoft $25 puts, worst case is you must buy 100 shares of Microsoft at $25, even if it tanks well below that. And that's only if the option expires and none of this matters. You're done. Remember, you can also buy you can also buy back the options. That's another. You don't necessarily have to buy the stock. Before it expires, you can buy back the option, but you're going to lose money on it because the option will be way higher than when you sold it if the stock's going against you. Your hope is that the underlying stock stays above the strike price and the options expire worthless. Advantage of naked puts is the odds are highly favorable if conditions are bullish and or the stock is clearly oversold. You can also make money holding no stock position. The disadvantage of naked puts is you must contain sufficient margin in case you are forced to cover. Now, I don't know. It depends on the broker. I think there's some cases where you don't have to cover the whole entire stock liability. All you have to cover is the loss that you'd have on the option itself, I think. It depends on the broker. Like, for example, like if you sold a $30 put and the stock tanks and now the put's worth $40, I think you only have to cover that $10 difference. I don't. Depends on the broker, but you have to have some margin. You have to have margin to cover the worst case disaster if you're selling these puts. Remember, if you write covered calls, you don't have any liability. You have none because you're covered by the fact that you own the shares. Now, by the way, you can sell covered puts. And the way you sell covered puts is you sell short, and then you can sell puts against that short position. But that gets kind of weird. Losses are potentially steep if the underlying stock tanks badly. That's the other downside. Now, credit spreads. This is the one area which I personally don't trade these, but I can totally see why others do, because it is ultra safe, it is ultra conservative, and it's almost impossible to lose money on it. I say almost impossible. There's no such thing as impossible to lose money on anything. But this is the closest thing, in my opinion, to you can't lose money on. But the problem is you can't make a whole lot either. But this is a great, great strategy for people that have, say, a big giant account or a big IRA, and they want to make nice, steady income. This is the way. Now, unfortunately, I can't get into all the nuances of credit spreads. That would take a whole entire webinar or two. But I'm going to give you the basic general gist of it. Here's the idea, and this is the most, there's all kinds of variations of this, and there's bull spreads, bear spreads, and God knows what else. But I'm only going to give you the most common one, which is, do you buy and sell an option at the same expiration but at different strike prices? That's the most common one, and usually they're both out of the money. Here's an example. Stock ABC is $47. You sell 1,048 strikes, which is options now, for $1 each, let's say. That's selling them, right? But you also at the same time buy 1,049 strikes for 60 cents each, let's say. Now, notice that these are they sell as a naked call. You don't own any shares. But the reason you get away with that in this case is because it's balanced by the fact that you're buying the $49 strikes. In most brokers, and each broker may be a little bit different, but they let you do this. It's like literally called a spread, and they'll let you set this up because, and I'm going to get to that in a sec, it's because your losses are limited, and your losses are known, and there's a max loss. And that's the liability you have to have. And you don't have, and it's not very big, and I'll show you that. If you did what I just showed you with those strike prices that we just made up, if the stock does absolutely nothing, or if it falls below both of those strikes, here's what happens. You receive $1,000 by selling those dollar options, okay? But the cost of buying the other strike is $600. So your net profit is $400. So you make $400 on that trade if the stock stays below those two strike prices. That's interesting, isn't it? No matter what happens, the stock could tank to oblivion and you still make $400. And you've lost nothing. Now, here's the problem, though. If stock rises above both the strikes, which is the worst case in this particular case. By the way, this is a bearish trade. You're hoping that the stock does not rise. You can do the opposite of this using puts, but I don't want to get too complicated. Now, if the stock rises above both strikes, which is your worst case, you have to unwind the cost. Now, I don't want to get into why this is, but it is. The loss that you have when it goes completely against you is the difference in the strike prices times the number of options that you traded. In this case, the difference in strikes is $1, so your worst loss is $1,000. Just take my word for it. It's $1,000 no matter what, no matter where the stock goes, if it's above the strikes. But remember, you made $400 from the sale of the other option. So your total loss is $600 in this worst case scenario. Now, here's the point. The point of the credit spread is that both wins and losses are limited, and they're known, and they're fixed. In the previous example, the most you will gain is $400, but the most you will lose is $600, no matter what the stock does. Now, that's actually very appealing to some people. Because I got news for you. In that example I gave, you're hoping that the price goes below the current price, right, or stays the same. I don't know about you, but I can find a lot of stocks on the chart that look pretty good for staying the same or going lower. Okay, so in other words, your chances of a win are very high. I'd say, if you're good at chart analysis, you can get 80, 90% certainty on these, which means your $400 win is almost for sure, and your $600 loss is unlikely. So that is a really good risk-reward right there. The most you're going to lose is $600. The most you're going to win is $400. That is not bad. However, I'm going to show you how you can vastly improve that using our report, High Premium. On the High Premium report, which I'm going to show you in a sec, it's pretty self-explanatory. I found one that would have been a killer spread play. That your limited, your max loss is very small and your max win was very large. There's a stock called JNUG, J-N-U-G, and I found it on the list. I didn't trade it. I didn't trade a spread or anything, but this is an example of one that you could have worked out. The stock is trading around $44.20. The call options, for some reason, were out the roof, really high premium. You could sell 1,000 $44.50 calls for $3.40. That's almost 10% of the stock, for heaven's sake. Okay. But then you turn around and buy $45 calls of around $3. And I actually looked up the prices. You could have closed this position. I mean, this could have been filled. And notice there's only a 50-cent difference in the strike price, so that's really thin. Okay, what happens is your net proceeds are $400 because let's say you do 1,000 of them, right? You're making $400 on just the transaction. Guess what? Your maximum gain is $400 and your maximum loss is $100. Talk about a no-brainer play. And by the way, JNUG I think is a junior gold miners or something like that. It's very likely it could just grovel and go sideways. And check it out. I didn't even tell you the best part. The option expires Friday. Friday. So this is telling you that you can make $400 most likely by Friday, which is what, 3 days? And this is phenomenal. Now, the only bad news is, what if it doesn't go your way? Yeah, you're going to lose 100, but it's a really excellent risk reward. The other downside is you might not get filled at these prices. I was just guessing at some of this because on the buy side, when you buy the $45 calls, the spread on those was a mile wide, and it was like the bid was like $280 and the ask was like $4 or something. I forget what it was, but I just guessed at a price that you probably could get filled on the buy side. So, but it's very realistic. This very well could have turned out. Anyhow, by the way, the reason here's how we computed that maximum loss. The loss is computed as the strike price difference, which is only 50 cents. Remember, you did 1,000 of them, so that's $500 minus the $400 that you made selling the other option. So it's 500 loss minus 400 gain, and that gives you a minus $100 worst case. And by the way, remember, the max win is 400. The worst loss is 100. Now, it's going to be somewhere in between that if the stock kind of comes in between the two strikes. For all types of option selling, the critical factor is the premium price. That's what you have to know. The higher the premium, the more profit potential. This is in all types of option selling. Hence the high premium report. This report, folks, scans the same 300,000 options. It looks for the maximum highest premiums relative to the time frame that you're going to hold. This is data that you can't get just by looking at various options. Like, you're sitting there thinking, I want to sell some puts, right? How do you know what's out there? Do you start walking through them, your favorite ones, and see what the prices are? You know, there's 300,000 possible puts you could sell. How do you know what what about the time premium? What about do you want to do Friday? Do you want to do 2 weeks from now, or what? So this is difficult stuff. So you really, if you're going to be selling options, the high premium report is an absolute must, in my opinion. And I will show it to you as we speak. There's really not much to show. It's the high premium report. Looks just like smoking gun, except in this case, this gives you the highest premiums relative to time. I would say the most important field here is probably this one here. It says PREM. What that number is that's this is kind of weird, but that's the percent gain. I don't even want to call it gain, but that's the percent of that's how high the premium is relative to the stock each day that you hold it. So for example, this top one here is Netflix. It says if you own Netflix, if you sell calls on Netflix, let's just say, for example, you're selling covered calls. You have a big IRA, right? You've got 1,000 shares of Netflix sitting in there. You could sell call options against that and make 1.7% per day averaged out by doing that. That is phenomenal. So if you were to sell $350 call options on Netflix, you would get you'd get $20 a share. $20. That's unbelievable. That means there's some bozo out there that's going to pay you $20 for those options. You bag that $20 a share no matter what happens. That's the beauty of it. And guess what? These are January 23 calls. That means these expire Friday. I don't know about you, but if I had 1,000 shares of Netflix, I'd take the deal. I'd take it in a second. Hell, you mean you're telling me? See, Netflix is trading at $348. They're telling me that I can get $20 a share right now if I agree to sell my shares at $350 by Friday. I'll take it. So this report could be really valuable. Now, it also could be valuable for finding really good spreads, like I was just showing you. And best of all, the naked puts is really cool. Like, check it out. You click the puts. Oh, that's how I found JNUG, J-N-U-G, is I found it on the put side. And midday was also on the call side, but then it flipped over to the put side. Who knows why? But the high premiums were way up there on the calls as well. Now, speaking of JNUG, there's a guy I see post once in a while on the forum that brags about, I don't know if brag's the right word, but he'll sell puts on $100 stock, and he says, whoopings, he got 30 cents a share, 40 cents maybe. I mean, come on, you guys. Look at this. This is a $45 stock. You can sell puts at $3. That's 10 times what that guy is making on his put sale. Now, I'm not saying that's a good play. It might be a terrible play. But use your technical analysis. Use your trading skills. Look at the chart. See what it looks like. Is it going to bounce? Is it hit a bottom? Is it oversold? If so, take a shot. Sell puts. You could make some huge money on some of these premiums. You could look at sell Netflix puts right now and get $18 a share. Oh my goodness. Anyway, high premium port is just that. You find the best premiums when you want to mess around with these spreads, covered call writing, and naked puts. It's great stuff. I think I have one more example, if I'm not mistaken. Yeah, here's a simple example of writing a covered call. Yeah, I went over it a little bit. Netflix. Midday today, if I owned Netflix, I could have sold. Netflix was trading at. Let's see. Yeah, I could have sold $337 calls for $17 each, and they expire in 1 week. But what I wanted to point out is you don't just blindly go by the report. You can also look up the actual option in your broker or whatever, wherever you look up option quotes, because if I go to when I looked up Netflix in my broker, see that all the options around the current price, near the stock price, are really high. So I could have chosen some really nice strikes. For example, Netflix at that time was trading at 337, I think. Yeah, but a $342 strike was still selling for $15. So that would have been a really fantastic deal. My point is that when you see nice things in the covered, in the high premium report, you can go look up the options and you can get some really good deals of all the options around that price. All right. And I think, yeah, an example I gave, like that $15 strike would have been beautiful. You sell calls, 100 calls for $15 each. You make $1,500 doing absolutely nothing. Now, the other good thing about that is you're selling that covered call. You have $15 of downside protection for only a 1 week hold. That means the stock could tank $15 and you're still okay. If you get called out, if the stock rallies and you get called out, you still get an additional $2 per share if you get called out. Your net gain would be $1,700. The stock did almost nothing, and yet you made a lot of money on that holding. Anyhow, we could go on and on and on about the various strategies of selling options, but that could be a whole separate webinar. Yeah, and I already covered this thing, the naked puts. I was showing you some of the really good plays, and you could go crazy selling puts. But remember, the liability of selling puts is you could get stuck having to cover that position. You can avoid that, or avoid the chances of that, just by being a good stock trader, just looking at the chart, saying this guy's going to bounce, or this is at a support level, et cetera, et cetera. Remember, if it turns on you too, you just do like what you always see, is bail out. You can always buy the options back and just take a hit. So I think we will have a separate webinar on just this stuff, because this is something that people could really get into that don't like the stress of just straight trading. Now, as far as how do you get this thing, if you don't already have it, Wall Street Smoking Gun. By the way, High Premium Report and Wall Street Smoking Gun, both those are the same thing. They come in the same package. You don't subscribe to one or the other or separately. They're both the same subscription. Eventually, I think we might split them apart and make them separate, in which case the price will go up twice, double, but not yet. This thing starts at $39.95 a month. It's less than that if you do 3 or 6 months. And by the way, we can't do any grandfather thing here. And the reason is because the data feed to scan those options is very expensive. And we have to support this service. So that's why I can't give away too much of a break. But we are giving one break, and that's if you buy this with the promo code SG. You get 1 extra month for 3 months, and you get 2 extra months for 6 months. That's probably the best we can do. All right. I can answer any and all questions now. Let me check it out. I think there's quite a few. Let's see here. Okay, Al is saying, what did he ask? Oh, no. Paul asked, how long or how many candles do you wait for confirmation? That's a good question. I don't know. That's a good question. I haven't thought about it. I don't know. I personally, and don't just go by what I'm saying, but I personally like to look at a 30-minute or 60-minute chart. I don't like, a 5-minute charts. It's too wild for me. If I'm looking at a 60-minute chart, let's say I'm looking at a 30-minute chart, I don't know, a couple of candles. It doesn't need many because 30 minutes is 30 minutes. But remember, I look at everything. I look at the market itself. Remember what I said earlier, the market itself can be confirmation because most stocks follow the market's lead. Premium has no export feature yet. God, Al, come on. It's going to, Al. It will have an export feature. Haven't gotten to that yet. But I promise you we'll put one in there. Maybe even a print feature. Probably just to export those. And you can export to your favorite gizmo like Excel or something. You say something here about when you are project, which is not to confuse the issue further, but trading debit spreads works well when you are projecting that the stock will get into the strikes and pocket the difference on expiration. Yeah, that's a debit spread, right? I think I was only showing you credit spreads. Yeah, this thing gets kind of complicated. You know, I didn't want to harp on the whole spread thing too much because it opens up a whole can of worms. My suggestion to everybody who's interested in that is just research it on your own right now on the web. Just do Google, you know, credit spread options or debit spread options, and there's a lot of information on it. And even Wikipedia has some really good articles on the whole thing. In fact, the example I gave you, you know, where that first example, I got that out of Wikipedia as an example they gave of your worst case loss and your best case win. But if this thing gets popular enough and we have enough experience, we'll have a separate webinar on just option selling and that kind of thing, you know, covered calls, naked puts, and credit spreads, or a series of options. Can fonts be enlarged? Everyone's telling me, drink some water, drink some water. I did. That's how I finally stopped. No, I just got over an illness of like a weird cold/flu thing, and that cough is the last thing lingering. I thought it was handled, and apparently it had a little flashback there. Okay, here's a comment somebody said here. It says, my concern, if I identify a favorable position through the premium SG, I must then buy a large quantity of stock that must settle. I have no idea how long that is. Then sell covered calls against those shares. That is going to take time, and the deal may be lost during that process. I actually found a website that I will not mention that provides the same live scanning that you do with high option volume, who charge $300 a month. I told you, I remember I said I researched this information. You're not going to find it in too many places. Okay, I understand the concern that you're talking about. I know what you're talking about. Two things I have to say about that. One is, you're probably talking about an IRA account that does not allow margin, because if you have a margin account, your stocks settle instantly. There is no waiting. From what I understand, I mean, I've never had anything on any margin account I've ever had. All transactions are instantaneous. There is no settlement time. And if you had a margin account, that would not be an issue. You could buy it and then turn right around and sell it. Now, the credit spread might be the better way to go if you have a real hard time with the settlement, because the credit spread, I think, now it depends on the broker, I think they'll just let that fly as is. You don't have to own any shares. And I believe the reason you get away with that is because your losses are limited. It's a known limit. Like, you will lose 500 if this goes worst case. And if you've got 500 in your account, I think the broker will let you do it. I think it ties it all up, but each broker might handle it differently. You'd have to talk to them about it. But otherwise, if you do have to let it settle, just keep in mind that then the way I would do the strategy, I would buy, if you have a large account that has no margin, let's say an IRA, what I would do is I would just buy stocks that I liked, period. And I'd gravitate to the ones that kind of sort of like to have high premiums. And then when they settle, then look around, fish around, see what the premiums are. Because remember, like another thing you can do is, man, my experience is when they show up on the high premium report, it's not like they disappear like in 2 hours. They tend to stay there for a while. Those high premiums tend to hold for a good, day or 2 or 3. So that might not be an issue. Take tea and honey and brandy. Somebody said on this JNUG example, JNUG, you shouldn't even be worried about being very close to the stock price. Well, yes and no. I didn't actually do that trade. I might have paid more attention to that, but I was using it as an example. As an example of something that within 3 days you could theoretically make 400 owning 0 shares. My audio might have cut out there. The webinar control panel is telling me that my audio was cut out. Anyway, I was only showing that as an example. Yeah, you might not want to be that close to the strike price because then you run the risk of going on the losing side in the example I gave. But you can still, doesn't stop you. That's why I showed you the example when I kept showing you Netflix. So I showed you looking up the option chain on my broker service to see what the other strikes are going for. Because if one call is really high premium, then it's usually the other calls near that strike are also high premium. And so you can kind of fish around like that. So in other words, the high premium report is the flag that tells you, take a look at this one, and then you do the rest of the research on your own. Somebody said option trading is good for small accounts. You said so before, right? Well, yeah. As a matter of fact, option, and credit spreads are also good for small accounts because remember, you can control the wins and the losses. But yeah, generally speaking, remember credit spreads and of course Bush's debit spreads, which we didn't even cover, but they're kind of similar but kind of flipped inverted. The appeal of those is that they're very conservative. You're not going to have any wild, crazy losses and wins. They can also be a little boring too. Sometimes you have to do a little soul searching, like, what is your main purpose of trading? Is it the thrill of the trade, or is it to make a little money? If the answer is it's the thrill of the trade, then you're barking up the wrong tree by doing credit spreads and things like that, because it's not going to be very exciting. You make a trade, and then come Friday, either you win, lose, or draw. I mean, that's it. It'll make you sick to see that the stock went soaring into outer space, and you only made 200. Somebody said you can't do options without a margin account. I think you can't sell options without a margin account, but I don't believe you need margin to buy options. I've never have needed margin. I've maintained for years a tiny little piddly account at Options Express. It's never been a margin account. No, wait a minute. Maybe I think it actually is a margin account. I just don't have any margin because the balance is never high enough. But I don't know. You always want a margin account anyway, even if you're not going to use margin. Why? Because then nothing takes time to clear. That's what a lot of people don't understand. The main reason you want a margin account is because there's no waiting time for buys and sells. Because technically it takes 3 days for your stock to settle on the buy and the sell. Well, that's nonsense. So in a margin account, the broker covers that for you, so you don't even notice the 3-day thing. Kevin says, still not quite sure how to use the high premium report. I don't know what to tell you. It's simple as this. If you're going to get into the business of selling options, if you're going to be buying options, the high premium report is of no use to you. Well, except you want to see what to not buy, maybe. But it's for the most part, if you're going to sell options, the high premium report tells you the best deals. All right? That's all there is to it. I mean, I don't know. How do you use it? I don't know. Take a look at it and just look at the top 10 and pick one. I mean, it's information for you. It's not a system. It's not like a stock picker system robot thing. It's information. Everybody's giving me all these recipes, you know. Somebody says they don't hear the answer about enlarging fonts. Look, a couple people have asked me about can they make larger fonts? I suppose so, but that's going to be a lot of work because it's not just a matter of making larger fonts. It's a question. Then the screen has to expand, the window has to get larger, everything has to grow. I mean, it's a complicated thing to do that. But I will definitely note it as a possible enhancement. Here's a good one. How does the program discriminate unusual options activity being sold at the bid versus being bought at the offer price? It doesn't, and it can't. That's impossible. Because, see, here's the deal. With every trade, there's a buyer and a seller. So if one says, well, was that trade, was that a sell or was that a buy? The answer is, it was both. It always is. But what you're saying is, how do you know if it was on the bid side or the ask side? There's no way to know. That's why, look, don't forget that the high volume report is a report. It's not a please trade me. I swear to God, if I hear one person say, Gar, this stock ABC is on the top, does that mean I should buy it? Oh God, if I hear that, I'm going to scream. Yeah, absolutely not. It means that somebody did a big trade on it. It could have been for a number of reasons. You know, like one thing I've noticed frequently, there's drug stocks that get a sudden spike with like options for 2 or 3 months out. And you wonder, what's that about? And then you realize, oh, they have drugs in trial. And you know what happens to drug stocks? If the FDA approves them, they go out the roof. And so there's probably a lot of people that sit there and they buy call options on almost every drug stock. And that, you know, you gotta use your head. You gotta have human intervention. You gotta think about these things. And so when you see an unusual volume, that's a green light. That tells you that you might want to look into it further. If you can't find a single reason why that should have happened, then that's time to keep your eye on that one, because maybe somebody knows something. That's why you need confirmation. So it's actually simpler than you might think. Can one use the instruments for earning trades? Yeah, here's the thing on earnings trades. I think what you mean is like if prior to earnings. I think what you got to look for there is see if there's also a lot of puts. It's like if you see a whole bunch of calls on, let's say, Facebook prior to earnings, flip it around and see if there's also a ton of puts. If there is, that means everyone and their mother's trying to play the volatility. You know, they're trying to play the spread on that. They're trying to go both sides. So if Facebook spikes one direction or the other, everybody makes money. I don't know if the spreads. I don't know if the heavy volume on pre-earnings really is that significant. And I actually don't know. I have to, because this product hasn't been around long enough. As we're going through the earnings season, I'm going to keep my eye on that and see if it does make a difference. So I don't know. I'm not sure I understand this question. Can one use a custom stock list from which to screen from, thus keeping the data presented at a minimum? Oh, I think what you're saying is can you create like a watch list from interesting ones from the big list? That's a very good question if that's what you're asking, because we totally intend to add that feature. Just hasn't been time. But in the very near future, you will see that in an update, the ability to create a watch list from your smoking gun list. See, I personally want that because it drives me nuts. I might have 5, 6, 7, 8 that I'm watching, and I keep forgetting which ones they are. So I'll do like Lico, use pen and pencil. Somebody said, I think you need to explain the advantages of smoking gun over the other programs. Well, the biggest advantage is it's real time. These things change, you know. I'll see something pop up like at 12 noon. And second advantage is it's not as expensive as a lot of these. I mean, somebody was just telling me there was a similar report, it's $300 a month. And then the biggest thing of all is that we're going to be improving on it over time. And there's all the other bells and whistles inside of Traders Unite. There's track trading, there's option trading, there's signature, there's charts, and like I said, soon we'll have watch lists for your smoking gun, and on and on and on. We do circles around these other people. So there. Yeah, now they're asking me about PowerScan and the filter manager. Look, that's next. That's next on the big agenda, I swear. Look, I desperately want to retire that old PowerScan program. It's the 1990s called me and they want it back, all right? So, believe me, it's going to happen soon. Somebody said you get a break in price if you subscribe for more than 6 months. Yeah, normally you would, but we kept it at 6 months right now. And I'd be honest with you, the reason we only have it capped at 6 months is because we had to see how popular this is. Because if for some reason no one wanted this, or very few people wanted this, we would have to obligate our subscription, right? We'd have to keep going until the subscriptions ran out. Well, we didn't want to commit to a whole year until we found out that this was popular, because it's very expensive. That's frankly the reason why we didn't go a year. But if it goes the way I think it will, because a lot of people are subscribing, which makes us happy. We'll add when you come up for renewal, we'll add a year thing on there. How will SG affect picks on Gar's Gold? Well, they're going to influence me a little bit. When we update the option list, just so you can see all options, that's a different thing. That's very complicated. I don't know the answer to when, but it's going to be as soon as possible. Right now, today there was a glitch in some of the option prices in our optionality because something overflowed. Our data got too large. And so I've got to really fix that. I cut the data back for tomorrow, so you won't have that problem. But these are the kind of issues that come up when we try to increase the number of quotes that are shown to everybody. No, somebody says don't retire Stockbridge. No, it's going to get retired, but it can't get retired until all of its features are migrated into Traders Unite. Look, trust me, you won't need that old program anymore once everything's migrated into the new program. Right now, it's some of the major PowerScan stock-based features are not in Traders Unite, and that's why it still exists. It's the only reason it still exists. What moving average, this is a question, what moving average will you use to confirm, quote unquote, the smoking gun time frame? Well, I personally like to use either 30-minute or 60-minute, and I use a very small average, like a 5 or an 8. And the idea is not for it to cross. The idea is for it to hover above and stay there. That's what I like to see. Just pick any stock at random and take a look at the 60-minute chart, put up a 5-period moving average, and notice that whenever it hovers above that line, it tends to be uptrending. When it hovers below that line, it tends to be downtrending. That's my favorite way to decide on a trend, is whether or not it's staying above or below that average. Somebody says an example. I'll tell you what, we'll look at a chart right now and I'll show you what I'm talking about. How about that? What shall we look at? Any chart. Let's pick up, well, how about VXX? That's one that I used to follow a lot when I was using what I just described. Okay, VXX, it's showing a daily chart at the moment. Let's go 60-minute. Boy, that's ugly. 60-minute. Now, here's what's interesting. Let's turn on a moving average. Let's simple moving average, not EMA in this case. Let's do a 5. Now, look at how fascinating this is. This is VXX. Some people love VXX in options trading. I do too, but I'm usually not around enough to because this is a kind of a day tradey sort of thing. Let me get a drawing tool here. Make it a little larger. Okay, here's you can see that white line is your 5-period moving average. You see how this thing hovers right here on the left side, hovers above? Well, look at that. This is a 60-minute chart. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 hours it rises because it's staying above the line. Look, and as soon as it starts groveling below, check it out, it crashes. You see? And then all of a sudden it's now above again for a couple bars, 2 or 3, and it just rises and rises. Crashes. That's kind of a head fake because it goes right back. Rises for many, many, many bars. So you get the idea. Now, right here you would have been driven nuts because it's rising and fall. Whoa, what happened? Because it's rising and falling. Yeah. Right here it's rising and falling all over the place, up, down, up, down. But for the most part, all this previous period, when the market is not as crazy, that moving average is one of the best ways to determine the stock direction. You don't need any other spiderweb charts, really. But that's VXX is just an example. I'm not even going to repeat what Al said. It's funny, though. I'm trying to see if there's any other questions. Many comments. No bad ones, thank goodness. Have you noticed any patterns yet in the unusual options activity results? They'll give you greater confidence to choose from one result from another. Well, yeah, the confirmation thing is really the main thing. I mean, remember, I've been watching these reports for weeks. I've been watching them since like late October, and didn't make any of them available. Didn't even talk about it till November, December, and I was trying to figure out a pattern, and then it suddenly the sky fell on me, and I said, duh, it's the confirmation. But the main thing I'd say for now, and I might discover some new stuff. A couple of people are helping me with that too. They're observing them daily, but it's so simple, it's pathetic. The smoking gun gives you the idea. The actual green light for a trade is the confirmation. I mean, I'm telling you, I have not seen that not work in 2 months. And now the bad news is there's not a trade every single day. But I can tell you right now that I'm talking about it thinking about it out loud, the service, the smoking gun window, desperately needs a watch list. I kind of agree with that one person who was asking about that. It really needs a watch list, and I'll tell you why. Because very often, something will come up in smoking gun, and I'll go, that one's interesting, and the stock will do absolutely nothing. The next day, it does nothing, and then the third day, boom, it's flying. And I'd forgotten all about it. That's happened more than once. And so I really need a really nice, easy to maintain watch list that you can add and remove so you can keep your eye on some of these. Yeah, somebody said the watch list should be shared among track trading. You know what? You're absolutely right. One of the things I know I'm going to have on that watch list is the track trading score. So you can, yeah, you're right. It should be shared on those same lists. You can go back and forth. Yeah, I agree. But keep in mind that smoking gun and high premium are going to be services offered to the outside world that don't know anything about Traders Unite or track trading or any of that stuff. In other words, the rest of the world, which is most people. Like this track trading, Traders Unite is this tiny little cult thing. I don't want it to be. I wish that it was all throughout the world, but it's not. and it's really, really hard to get new people interested. But I believe, if I'm not mistaken, smoking gun and high premium will be very interesting to outside people. So what my point is that whatever feature we add has to appeal to the broad usage. So yeah, it'll integrate with track trading, but that doesn't mean anything to Joe Schmo who doesn't use Traders Unite. Anyway, I think I answered most questions. We've been here a long time, an hour and a half, so I'm going to close the shop, and I hope we'll have more webinars on the subject. Trust me, I know we have to have some purely on the whole option selling side, the spreads and all that, because that can be very complex. It's not really that complicated. It's just hard to get your mind around it at first. All right, so on that note, I'm closing the shop. Thanks for attending.